We're going to expand the basic accounting equation to include the earning of revenue and the paying of business expenses. The expanded accounting equation involves adding some new accounts to the basic equation of assets equals liabilities plus owner's equity. Revenue is the classification that represents anything that the business earns. With service companies, service revenue is the account we'll be using. Since revenue increases owner's equity, we'll put it in that area. Expenses is the classification that represents costs incurred, whether paid in cash or not, in operating the business and earning revenue. Accounts range widely from advertising expense to utilities expense and include many others, depending upon what the business owner wants to track. Since expenses reduce owner's equity, we'll put that in the owner's equity section of the equation. One other account affects owner's equity. The owner's drawing represents amounts that the owner has withdrawn from the business for personal use. The owner's drawing account also reduces owner's equity. So let's try some transactions with our new expanded equation. Notice that our accounts start with a beginning balance from the previous transactions. In transaction number 1, the business provides $2,000 in services to a customer on credit. Since the customer did not pay in cash, accounts receivable is increased by $2,000 to reflect the amount owed to the business. Service revenue is also increased by $2,000. This results in $12,000 in assets by adding the asset accounts together, $500 in liabilities, and $12,000 in owner's equity by adding capital to revenue. In transaction number 2, the business writes a check for $500 for rent for the month. This results in a $500 reduction in cash and a $500 increase in expenses. Notice again that the equation is still in balance with $12,000 in assets, $500 in liabilities, and $11,500 in owner's equity. The owner's equity is calculated by adding owner's capital and service revenue and subtracting both expenses and owner's drawing. You subtract these two balances because both expenses and owner's drawing reduce the owner's equity in the business. In transaction number 3, the business borrows $5,000 from the bank on a note. In this transaction, cash is increased by $5,000 and notes payable is also increased by $5,000. This gives us balances of $17,000 for assets, $5,500 in liabilities, and $11,500 in owner's equity for a balance of $17,000 on each side of the equation. Don't forget you are subtracting the balance in expenses. In transaction number 4, the owner withdraws $500 from the business for personal use. This transaction is recorded as a decrease of $500 in cash and an increase of $500 in the owner's drawing account. Ending balances of cash, accounts receivable, supplies, and equipment sum to $16,500. Liabilities total $5,500 and owner's equity is calculated as $10,000 plus $2,000 minus $500 minus $500 for a total of $11,000, which when added to the $5,500 in liabilities balances to the $16,500 in assets. You should now be ready to record transactions using the accounting equation.